In 1979, Pink Floyd released The Wall, a record about the barriers people build brick by brick out of fear. Well, Wall Street's had one of those walls of its own lately. There's actually a name for it on trading desks, a wall of worry. And this past week, the market climbed it. I'm Jose Martin with LifeCraft Wealth Management, and this is your Monday Market Minute. It wasn't a straight line. The NASDAQ actually dropped more than 3% in the first 3 days of the week before clawing all of it back by Friday. What turned it around? The four largest tech companies all reported earnings, and together they said they plan to spend somewhere between $720 and $745 billion on AI infrastructure this year alone. Well, investors took that as a green light, and by the closing bell Friday, the S&P 500 was up about 1.1% on the week, and the NASDAQ was up about 1.6%. Not everything got better, though. Bond yields kept climbing. The 30-year Treasury hit its highest level since 2007, and the 10-year capped a level it hasn't touched since last January. Oil ticked higher too, as tensions flared again around a key Middle Eastern shipping route. Both of those raise real questions about inflation and borrowing costs going forward. But here's the part worth sitting with. A widely followed survey of everyday investors has now shown more pessimists than optimists for 25 straight weeks, even as the market climbed to within striking distance of its highs. That's the wall of worry in action. Stocks don't need everyone to feel good to go up. Sometimes they climb precisely because so few people believed they would. Gloom and a rising market aren't actually a contradiction. Historically, they've traveled together more often than you'd think. The wall gets built brick by brick, and so does the case for not reading too much into how any 1 week feels. I'm Jose Martin, and I'll see you soon.